Welcome to the Good Capital channel. A huge thanks to my teachers across Singapore and professionals for foundational research and knowledge. Please remember, this content is for education and entertainment only, never professional advice. Investing involves risk. Consult with a certified professional before making any investment and trading decisions. Let's keep learning together. Today, we are stripping away the hype and looking at the cold, hard, undeniable business logic behind the top 5 largest SaaS companies on Earth. We have leveraged real-time market search and deep financial knowledge base to retrieve the exact fundamental data like ROIC, WACC, and business models required for this rigorous assessment. We need to understand the ultimate secret to the wealth-building abilities of these companies, the economic moat. We evaluate a company's structural durability by its ability to sustain economic profits, defined as returns on invested capital, ROIC, exceeding the weighted average cost of capital, WACC, over a full business cycle. Think of this like a lemonade stand. If it costs you 8% in interest to borrow the money to buy lemons and sugar, that's your WACC, but your stand generates a 23% return on that cash, that's your ROIC. You are printing money. That spread is what generates real passive income and massive portfolio growth. The 5 sources of moat: 1. Intangible assets. 2. Switching costs. 3. Network effect. 4. Cost advantage. And 5. Efficient scale. We aggregated the moat and pricing power rating for Microsoft, Oracle, Shopify, Palantir, and Salesforce. Let's start with a juggernaut operating across productivity software, enterprise cloud infrastructure, and personal computing. Detailed moat analysis. Network effects, 9 out of 10. The value of platforms like LinkedIn and Microsoft Teams increases exponentially as a user base expands, creating a virtuous cycle that draws in more participants. Switching costs, 10 out of 10. Microsoft's products are deeply integrated into enterprise IT workflows. The risk, expense, and operational downtime required to rip out Active Directory, Azure, or Office 365 makes the cost of failure exceptionally high. Cost advantages, 8 out of 10. As a hyperscaler, Microsoft benefits from massive distribution and manufacturing scale in its data centers, allowing it to achieve higher margins at the same price as smaller rivals. Intangible assets, 9 out of 10. Decades of brand equity and a vast patent portfolio block competition and allow for premium pricing. Efficient scale, 6 out of 10. The extreme capital intensity required to build global cloud infrastructure requires massive sunk costs, effectively limiting the market to an oligopoly. Pricing power, dominant. Microsoft exhibits top-tier gross margins, consistently 70% with exceptionally low volatility. The company successfully commands price increases for its enterprise software, for example, Copilot rollouts without volume loss, driving margin expansion during all economic cycles. Number 3, financial reality. Microsoft consistently generates immense economic profits, with a recent ROIC historically stabilizing above 23% against a WACC of approximately 8 to 9%. The firm maintains a massive, sustained positive spread. This mathematical footprint proves high capital efficiency and value creation. Number 4, risk assessment. But it's not bulletproof. Regulatory scrutiny and antitrust actions over software bundling, such as embedding Teams into Office, threaten the moat. Additionally, the rapid commoditization of foundational AI models could eventually pressure cloud compute margins. Number 5, Microsoft has wide moat, high confidence in excess returns for 20 plus years. Microsoft possesses one of the most durable competitive advantages in the global market. Microsoft is a beast, but wait until you see the hidden vulnerability in our third company that AI might completely destroy. We'll get there in exactly 3 minutes. Next up is Oracle, the pioneer specializing in mission-critical database management systems, ERP software, and an aggressively expanding cloud infrastructure segment, OCI. Detailed moat analysis. Network effects, 4 out of 10. Weakest area. Oracle relies on technical lock-in rather than user-to-user ecosystem expansion. Switching costs, 9 out of 10. Switching from Oracle's tightly integrated databases could cause massive, paralyzing disruptions to a corporation's core operations. Cost advantages, 6 out of 10. The firm possesses high scale in R&D and sales, though it still trails AWS and Azure in raw infrastructure scale. Intangible assets, 7 out of 10. Oracle holds a definitive brand name and intellectual property for relational databases. Efficient scale, 6 out of 10. High barriers to entry exist for creating enterprise-grade, zero-downtime database replication. Pricing power, strong. Oracle commands stable gross margins in the low 70s. The firm exercises an almost unchecked ability to regularly raise maintenance and support fees on legacy customers who face prohibitive switching costs. Financial reality. Oracle's ROIC sits comfortably above its WACC, though historical returns were occasionally diluted by aggressive acquisitions. Its recent pivot toward highly profitable Gen 2 cloud infrastructure is expanding the positive ROIC-WACC spread, confirming sustainable value creation. Risk assessment. Cloud migration risks remain the primary threat. As legacy customers transition to the cloud, they have the opportunity to architect native solutions on rival platforms like AWS Aurora, bypassing Oracle entirely. Oracle has wide moat. The extreme switching costs inherent to its database products provide high confidence that Oracle will sustain excess returns for at least a decade, with durability highly likely. If you're building a strategy for portfolio management, understanding these switching costs is the difference between catching a falling knife and buying a fortress. Let's look at a company that practically invented the modern CRM fortress. 3. Salesforce CRM. Salesforce is the pioneer of cloud-based customer relationship management (CRM) software, expanding via acquisition into a broader suite of enterprise marketing, service, and analytics tools. 1. Detailed Moat analysis. Network effects, 7 out of 10. The App Exchange creates a vibrant platform ecosystem connecting third-party developers and enterprise users, where adding a user increases the value for developers. Switching cost, 9 out of 10. Salesforce's automation application is mission-critical to business users because it drives selling processes and is tied to a variety of other back-end systems. Moving away carries high organizational risk, time, and expense. Cost advantages, 6 out of 10. The company benefits from immense distribution scale. Intangible assets, 8 out of 10. Salesforce holds the premier brand name in CRM, enabling it to sell at a premium to competitors. Efficient scale, 5 out of 10. Not a primary driver for standard SaaS platforms. 2. Pricing power analysis, strong. Salesforce maintains excellent gross margin stability at around 75%. It exhibits the ability to consistently pass on inflation and input costs, securing margin preservation despite rising operational costs. 3. Financial reality. Salesforce historically favored aggressive growth over immediate capital returns, but it has recently pivoted toward margin expansion. Its ROIC is now expanding meaningfully past its WACC, proving the underlying profitability of its subscriber base. 4. Risk assessment. Here is that massive red flag I warned you about. The seat-based pricing model faces secular threats from AI automation. If AI agents replace human sales or service representatives, Salesforce's billable seat count could shrink materially. 5. Salesforce has wide moat. Evolving from a narrow assessment in earlier years, its deeper enterprise integration has cemented a wide moat with highly defensible economic profits. Salesforce possesses a highly durable moat. However, as an analyst, I must note that the rapid proliferation of AI and the scrutiny on traditional seat-based software subscription models pose a risk of moat erosion. If AI agents begin replacing human sales seats, the terminal value of the switching costs could be pressured. 4. Palantir Technologies, PLTR. Now we shift to Palantir, a company building big data analytics software, Gotham, Foundry, AIP, originally designed for government intelligence agencies, now aggressively expanding into the commercial enterprise sector. 1. Detailed Moat analysis. Network effects, 6 out of 10. Developing a localized data network effect as its ontology models train on vast datasets, though this is often siloed by strict client security needs. Switching costs, 9 out of 10. Palantir embeds forward-deployed engineers directly into the client's core operations. Once Foundry or AIP is integrated into an organization's central nervous system, the cost of failure and switch time is severely prohibitive. Cost advantages, 5 out of 10. Historically weak due to high bespoke service costs, but improving rapidly as software deployment becomes modular. Intangible assets, 8 out of 10. Elite, hard-to-acquire government security clearances and proprietary machine learning algorithms serve as strong barriers to entry. Efficient scale, 5 out of 10. Niche dominance in Western defense analytics discourages new entrants. 2. Pricing power analysis. Strong, gross margins are exceptionally high, about 82%, and stable. Product criticality. Palantir's platforms are utilized for existential, high-stakes problems, from Pentagon Battlefield AI, Project Maven, to optimizing global supply chains and executing complex data migrations. Customers are highly price inelastic because the software delivers asymmetric ROI, return on investment, that dwarfs the subscription costs. Palantir operates in a space with low substitute availability, allowing it to preserve margins and command premium contract values. Quantitative profile. Palantir does not compete on price, it competes on time to value. Its ability to command premium pricing is evidenced by its rapidly expanding remaining deal value, RDV, for U.S. commercial contracts, which surged 145% year over year to $4.38 billion in Q4 2025. Customers are willingly locking into large long-term contracts. Financial reality. Palantir has achieved a profound inflection point, with ROIC recently surging into the high double digits against a WACC of 10%. It has established a massive positive spread. This confirms a transition from a cash-burning startup to a highly profitable compounding machine. Risk assessment. Heavy reliance on lump-sum government contracts leaves revenue vulnerable to geopolitical shifts and budget sequestration. While the durability of Palantir's moat is exceptionally high, investors must be acutely aware of valuation risk. Trading at a forward PE multiple frequently exceeding 100x, and an enterprise value to sales multiple representing a massive premium over the broader software index, Palantir is priced for perfection. Any deceleration in commercial contract conversions or tightening of IT budgets could result in severe multiple compression. Palantir Technologies' PLTR has narrow moat, positive trend. Palantir is highly likely to earn excess returns for at least 10 years, and its strengthening commercial adoption suggests it is on a trajectory toward a wide moat.
Finally, we arrive at Shopify, a leading e-commerce platform providing storefront infrastructure, payment processing, and back-end management tools for merchants ranging from entrepreneurs to large enterprises. 1. Detailed moat analysis. Network effects, 8 out of 10. Shopify possesses a powerful two-sided network effect. A massive merchant base attracts third-party app developers, which in turn makes the platform more valuable to new merchants. Switching costs, 8 out of 10. Once a merchant builds their store, integrates inventory, and uses Shopify payments, migrating to a new platform incurs severe business disruption and lost sales time. Cost advantages, 5 out of 10. Limited, as it relies on merchant volume to negotiate payment processing rates, but it lacks the physical cost advantages of a true logistics player. Intangible assets, 7 out of 10. A deeply trusted brand among independent merchants. It is the default, top-of-mind operating system for entrepreneurs and, increasingly, enterprise brands via Shopify Plus. This brand awareness lowers customer acquisition costs relative to peers. Efficient scale, 4 out of 10. The e-commerce platform market is large enough to support multiple players, e.g., WooCommerce, BigCommerce. 2. Pricing power analysis, moderate to strong. Customer elasticity and market share. Over the past few years, Shopify has successfully executed significant price increases on its core subscription tiers. Despite these hikes, churn remained remarkably low, proving that the software is a price-inelastic, mission-critical utility.
Financial reality. After a period of overexpansion during the pandemic, Shopify has right-sized its operations, e.g. divesting its logistics arm. With a double-digit ROIC comfortably exceeding its WACC, it demonstrates a restored, sustainable spread. Risk assessment. Shopify has heavy exposure to small and medium business SMB failure rates. In a severe macroeconomic downturn, merchant insolvency will directly erode recurring revenue. Shopify has narrow moat, positive trend. The firm has definitively secured its place as the premier independent e-commerce infrastructure. Shopify is no longer just a beneficiary of e-commerce tailwinds. It is the infrastructure dictating the terms. While the stock's premium valuation multiple inherently carries risk in a high interest rate or recessionary environment, as its SMB merchants are macro-sensitive, the structural durability of its switching costs and its aggressive expansion into enterprise and B2B markets solidify its status as a wide moat compounder. Most people just read the headlines. We check the facts and navigate through the pitfalls and fluffs. If you found value in our sharing, please like, subscribe, and share. All of your support is precious to our small channel. To stay ahead of the market with a level head, hit the bell. We'll see you in the next one.